Hi there, you guys, and welcome to Real Estate Divas. Today we are going over our kind of what we've been the topic. What's been the topic on our last few episodes?
Owner financing, subject to any of those.
Yeah, getting creative. That's really what we're encouraging everybody to do. And today's episode is kind of breaking it down for A to Z, breaking it down, owner financing 101. I'm Jay Lee Thompson with Texel Real Estate, and
I'm Kristen Gerst with Capricorn Mortgage Investments.
And we are happy to be here today talking to y'all about Owner Financing 101.
So, Jay Lee,
yes.
What is owner financing? Because everybody's going, I hear all about this owner financing. It's going to be awesome, for 2021. I got to learn how to do this. What is it?
What is it? Well, owner financing is basically where you are taking over a property, and that's either through a wrap, like we've talked about before, and we'll hit on that briefly, but a wrap, or you own the property and you don't want to rent it. You don't want to be responsible for it. And so what you're going to do is you're going to sell it to someone and you're going to become the bank. You're not going to be in charge of that property. You're not maintenance on that property. You're not dealing with plumbing at midnight. You are the bank on that property.
And that's what I love about it. Yep. I actually, and I tell everybody this, I make more money owner financing and being the bank than I do as a renter, as renting it out and being a landlord.
Yeah.
Because you are not responsible for all of those things.
Well,
and you still get cash flow.
It's a lot less headache for sure.
Yeah. Yeah. So just remember when we're talking about owner financing, at the time of the sale, you're going to get one lump sum down payment, right? It's usually about 10% of the
and
total.
that down payment, no matter who you are, if you're trying to buy a house, you're saving up for a down payment. Like, that's to be expected. You're going to ask for a large down payment. A lot of people are like,
especially if that buyer can't get credit.
Yeah.
If they can't qualify for a mortgage, an FHA mortgage that will be 3% down, they are going to need to put a large down payment. And you'll want that because you want to know they have some skin in the game.
Exactly. And that's part of what this process is making sure that they've got some skin in the game and you're getting paid for having that property and taking a risk on them. Because most of the people that are willing to do an owner finance property or are interested in owner financing can't get a loan otherwise. They can't get a loan through your regular big box, banks or mortgages or anything like that. They've got to do the owner financing because either the credit's bad, maybe they have a ton of hospital bills, college debt. I mean, there's a plethora of reasons why they can't get approved.
Also, shockingly, I get owner finance applicants in, and they have actually pretty decent credit. Like 650, 700.
Oh, wow.
But some people assume that they're going to fail, and some people don't like banks. They don't trust banks. So they want to go lender to lender, and they're willing to pay a premium in interest rate for that.
Well, and that's the other perk of it is you get that interest premium whenever you're doing owner financing. You're not doing your typical, 3%. Everybody's out there going, oh my gosh, 3 and 4% mortgage rates out there. Yeah, it's an all-time low if you can qualify. And if you can't qualify, then you're going to be paying a lot higher for that, what's the word?
Opportunity to buy to be a homeowner. Yeah,
exactly. So you're going to be charged more like 9%, 10%. I mean, that's really where you're looking. Sometimes even 11. It just depends on who it is that's owner financing to you. What is it that they want? Because a lot of times what they want is a big down payment,
right?
And then in addition, they're going to charge you, 10% interest, but then maybe a couple of points too, because that happens a lot.
Yeah, and really, we'll go into that, especially with, using your RMLO to tell you what the max is. Surprisingly, because interest rates are so low right now, to stay below a HOPE mortgage, it's about 9.5%.
Yep.
Whereas a year ago, we were seeing 10.5% for an owner finance mortgage. So, and we'll go into that. So the next thing is, what can you owner finance? And I love this.
Pretty much anything.
Anything.
Yeah.
Doesn't matter what
I'm like sitting there going, well, maybe not a tent, but
you can owner finance. You can owner finance vacant land. You can owner finance any piece of property, commercial, residential, industrial, self-storage, anything that you want to buy that's real estate related, you could then sell it on terms. And that's the other way to say it.
And it's not a bad deal for the people who want to get into that. Let's say I want to start getting into storage buildings or something. If somebody's willing to owner finance that to me and I can't get approved otherwise, then owner finance that, have it for a few years, and then refinance and get your, conventional loan.
Correct.
Yeah.
Correct. So where does this work? Everywhere. It's being done in every state in the nation.
It's not illegal. It is like so often, like we talked a couple of weeks ago when we were talking to Grant, so many agents out there think that owner financing is illegal. Or you talk to people in other states, like I know Colorado says that they don't owner finance, but there is there's definitely something that they do in Colorado that's similar. It's called something different. It's so common in Georgia that they have actual contracts that me as an agent, the state provides, and I can provide my owner finance either buyer or seller that is a standard contract
for that
for seller financing.
Right.
And that's in Georgia. So every state's a little bit different and may call it something
different.
different.
In Texas we have state contracts. We have a seller financing addendum.
Yes.
So you take your 1 to 4 family and then you put your seller financing addendum to list out what the terms are. And it's a standard contract that you can get for free on track.gov website.
And any of those, if the state actually makes those forms, then any state's going to be able to provide that on their real estate commission boards. You're going to have to do a little bit of digging because we're in Texas. So, we're pretty familiar with Texas.
Really, and anytime I've done it in any other state, first thing I do is I go Google that state's real estate firm, whatever it is, agency.
Yep.
And I go look at what contracts they have available.
Well, and that'll give you really some good insight as to how they do real estate in that state.
Right. So the last point about this, and we kind of already touched on this, people think, the only way I can own or finance something is if it's paid off free and clear so that I don't owe any money on that. No, absolutely not. And at the end of our kind of presentation here, the last thing we're going to touch on is how to pick these properties up, finance them, and then do something called a wraparound mortgage so that
you're still paying it off. It's kind of like whenever you're renting a property. When you're renting a property, most people that are renting properties, they're still paying on that property. You're still paying that mortgage. You're paying that note off, and those rents are helping to pay that down. That's exactly what you're doing here, except you're going to be making more money. And
what people don't realize is that every bank lending you money has underlying debt on that money that they're lending you.
Yeah, it's kind of the trickle down.
And everybody is borrowing it from somewhere, and it usually ends up to be the federal government. But everybody is borrowing money.
Yeah.
So once you realize that, no, none of this is illegal.
Yep. It's just a matter of doing it right. Now, we did touch on that is there are particulars that you need to know. You need to, cross those T's, dot those I's, because
and this is just kind of a brief overview on how to do this.
Do that. So,
jumping into the
next slide,
the next part.
So identifying the properties.
Right. So just the steps. What are the basic steps to go through?
As far as going out there and getting the property?
All
right.
All right. So you want to have an owner finance note. How do I go about that? What are my basic steps? Not in detail, just my basic steps to doing it.
So basic steps is, you want the property. It's either a property you already own or something you're going out to find. It's any property that you would look at to rent. It's any property that you would look at to flip. All of those are candidates for seller financing. It's just really any neighborhood that is not just absolute crud. You don't want to be in a war zone.
No.
But
again,
owner financing happens there too. It's just not the premium.
So we identify the property to be sold, figure out what it's worth, what the condition is, where it's at. And once you own that property, and we'll talk about how to finance it down the way, you're going to advertise for owner finance buyers. And this is the one where people are like, well, how easy is it to find somebody like
Owner
this?
finance. Oh, I can't tell you how many times I've listed one on the MLS. I've gotten a call from a realtor telling me that's illegal. You can't say that it's seller financing and that it only people who are doing seller. And I'm like, that's what the
Okay,
owner
there's
wants.
a-
Yes, I can.
And there is a box you can check.
Yeah. So seller financing, again, is legal. You can put it on the MLS if you're a realtor, or if you've hired a realtor, they can put it on the MLS as that to attract those kind of buyers. But in addition, social media people.
Yeah,
Oh my goodness.
Facebook Marketplace is how I'm finding majority of my buyers right now. It used to be Craigslist, and buyers have kind of gotten away from that, but Facebook Marketplace is great. Number one thing you need to do first is you need to go get a blank sign and a big magic marker. And in your...
We're talking money, people.
I know. We're talking super cheap. You know, we're talking about the dollar sign, you know, the sign, the big yellow bright sign on the wire stake.
Yeah.
And in your not best penmanship, make sure it's legible, but make it look like maybe you're special ed or in third grade, something like that. You will get more calls if that sign is written out and looks unprofessional.
Well, yeah, because they think that they're going to get a better deal.
They do. They think that they're dealing with somebody who's
if
not
they
very
think
savvy.
that if they think they're dealing with an actual business or corporation or something like that, then they're automatically going to assume that they can't afford it or they can't do it.
So, yes. And what do you put on the sign? I usually put how many bedrooms are in that house. I always say owner will finance. I always say bad credit, okay.
Because that's the typical buyer.
And they want to know that just because their credit is terrible and in the pits, and they will all talk to you about it when they call you.
They'll tell you about their bankruptcies. They'll tell you about all of it.
Right. And they'll say, oh, I don't think my credit's very good. That's okay. We accept bad credit. Again, you want to put that on the sign so they're not afraid to call you. And then you just put your phone number down below.
Yeah.
And it's that easy to get people calling you on that sign. I also, now this is, okay, so I'm not an attorney. I will tell you that what I'm going to tell you, this is my little trick, is technically against the law. And I don't still do it. But if you want to sell
we're getting a raise.
I'm getting raised.
I'm like, what is she about to say?
I'm going to say it anyways because it's a great way to sell a house, owner finance. So I always wanted contractors and families. So depending on the price of the house, so if it was a $100,000 house or less, I would put these bandit signs at the entrances and exits to Walmart and Home Depot. If it was $100,000 or more, I'd put them at Lowe's and Target. And that's, you know, and grocery stores, whatever is nearest to that place, right? Yep. And for that, you can write the same thing on the sign, but here's the tip. Make sure and go get an untraceable Google number that is transferred to your phone.
And expect those signs to be picked up.
They will. And in fact, I was once detained, not typically arrested, but I was detained and not allowed to leave by the dog catcher of Box Springs, Texas.
Oh my goodness.
And I had to really play dumb because they wanted to fine me $40,000. They said, we have over 200 of your signs in storage. We've been looking for you for quite some time at a penalty of $200 a sign.
Nice.
Yeah. So be careful. Look out for the dog catchers. I used to do it before dark.
Yeah.
That one I decided, I'm like, I got a few minutes. It's 2 o'clock in the afternoon. I'm going to stick some signs
So just know if you're taking that tip that you are definitely taking a risk.
The other fun thing is on a Saturday, you can see the code guy going and picking up signs. So I just drove behind him, waited for him to go, and I just put them back up.
Yep.
Because I especially like them at the end of the weekend because then they could stay up Saturday and Sunday. Friday, Saturday, Sunday. Again, tip, but be careful. Be careful
because you may actually get fined. Just know, don't come back to Kristen and go, hey, they fined me. They want $1,200 from me. Are you going to help me with this? You told me to do this.
But I got to tell you, it's the best way to get a buyer.
Yeah.
An owner finance buyer. And have lists of owner finance buyers going forward because you just keep getting calls.
Well, and that's the
On it.
thing. Most of the owner finance people who specialize in owner finance, they keep that list because owner finance, since it's not like just going out and buying a regular home and buying anywhere, they keep their list of those finance buyers. And the moment that they have a property coming up that they know they're going to owner finance or someone else is going to owner finance, then they can reach out to them and immediately get them filled.
Right. And I used to keep that list. And then I was reaching out to other investors going, anybody have a house they want to owner finance?
Yep.
I've got some great buyers here who have great down payments.
Exactly. So don't let that part scare you, is that it's not a typical buyer. They are out there. There's a ton. I mean, it takes all kinds to make this world go round. And as far as owner financing goes, you'd be surprised how many people are interested in owner financing.
And who have 10 to 20% down.
Yeah.
I mean, I've had people come in with $60,000 in cash, which we then sent them across the street to get a cashier's check because we're not laundering money at the title company. But yeah, absolutely. So once you do that, once you've got your buyer, and it is really easy to get these buyers, once you do that, then you're going to negotiate your terms and prepare a contract. And as we've said, go find a contract on whatever state you're in.
Yep.
And use that. You do this enough. Some people like to make their own contracts. I don't like to do that because it's unofficial. And I find that if you use your own homemade contract, people really, really nitpick it, tear it apart. Maybe I should have somebody look at this. But if you're using your standard state contract and addendums, everybody's like, oh, okay, well, that's just the regular thing that everybody uses. And so they're not going to go tear it apart.
Well, that, and, when she says make your own contract, we're not talking about somebody typing. We're saying you make your own contract by talking to an attorney. That's if you're going to go out on your own and you're not going to use the state provided contracts to put something like that together. Have it done by an attorney so that you don't, because we're not talking about all the people out there that have been doing it for years. Obviously, you know what you're doing. We're talking about people, if y'all are thinking about doing this for the first, second, third time, seriously, contact an attorney to write up your contracts. Don't try to do that on your own.
But I'm telling you, just go use the state ones. I do. I still use the TREC 1-to-4 family and a seller financing addendum.
Yeah,
that's what I've always used, and I'm never going to deviate from that. So, whatever.
Well, and like I said, whenever I saw the one, it was a family member sent me one to look over from Georgia. I took a look at it, and that's before Texas had their own. And I'm going, what? They have an entire 10-page contract that is all situated around owner financing.
Right.
It was amazing. Right. It was really crazy.
No, that's awesome.
Yeah.
So next, and very important, close at a title company with a title policy. If you go to the title company and they tell you, oh, we don't issue title policies on owner finance deals, go get another title company.
There are other title companies out there that are very familiar with this process. Some people, if they are not, these title companies, if they're not familiar with the process, this isn't something that they commonly do, they're not going to dip their toe in it. They're just going to tell you, oh, we can't. But don't take that as a solid answer of it's not available. It is.
Right. And so a lot of owner finance investors out there too, they're like, well, we've only got a certain amount of down payment. Right. And I get that. I hear that. You can roll the closing costs into their loan, all of them, and then take the money that they've put down off the top of that. Totally acceptable. So you still want to do this at the time of sale because you want the buyer to pay for that title policy. Remember, your buyer or your borrower pays for all closing costs. If you don't get that title policy and you decide to sell that note down the road, which, call me, I hope you do.
Yeah.
But if you do decide to sell your owner finance note at some time and you don't have a title policy on it, a note buyer is going to make you buy one, and that's on you, not on the borrower.
Yeah. And then as far as notes go, because I know we're kind of She talks about notes all the time, but before I met Kristen, I was like, what? I mean, I knew about the general term, but I didn't know individuals and smaller companies bought these things. That's a whole nother ball of wax, but it is awesome. It's a pretty, if you don't want to hang on to that property,
Well, you know,
it's
and a
an
lot
option.
of people don't.
It's
And
an exit strategy.
right. And
Yeah.
I hear it from tons of investors. Oh, you know, I just don't want to have this thing for 30 years. And I'm like,
You don't have to.
right. So there was one last thing. Oh, the last thing you have to do once you close on it from a title company, always set it up with a licensed third-party note servicer.
That's very important. That's where a lot of people get in trouble, is not setting it up with that third party note servicer. Just a professional company that does this for you.
I have been doing notes for 12 years.
Mhm.
12 years, going on 13 years now, and I am not qualified to service my own notes. I've tried it. I did it all wrong. I broke lots of rules. So just remember that if you think, oh, I'm going to save some dollars, you're saving nothing, and you're giving yourself a lot more headaches because your borrower pays for it if you set it up at closing that way.
Well, and not only that, if you don't do it this way, you are really, it's not only going to cost you money, you're leaving yourself wide open if you do it wrong.
Right.
I mean, wide open for all kinds of litigation. So you don't
Right.
want to go
If
that
that
route.
note goes bad, and God forbid it ever does, but if it does and you are not using a licensed third-party note servicer, that can come back to haunt you from a judge's standpoint, and you could lose. So always make sure you do that. But also, again, with the exit strategy, if you decide down the road that you want to sell that note and you are self-servicing it, I am going to discount it usually 3 or 4% on what I would usually
Yeah, they're
would
not
have
as
paid
attractive.
before.
Well, because you're taking on that liability.
Well, if it's set up that the lender is paying for that thing, that
Yeah.
means I have to pay for it. The
Yeah.
borrower is not paying for it because it wasn't set up at time of closing. Well, that's $35 on me
Mhm.
per month. And that takes out from my yield. So of course I'm going to have to not give,
Recoup that somehow.
am.
Yeah.
because I buy on yield, and so obviously I'm not going to give as high an offer.
So overall, just get a professional. That one, get a professional.
Right.
Yeah.
So let's talk about what makes a desirable owner finance. And again, I've owner financed some garbage,
Mhm.
like some awful, awful garbage. I owner financed 2 years ago a lot with a broken down mobile home on it with a tree that was growing up through the middle.
Which just tells you can own or finance anything.
But if you want to get something great,
Yeah.
right, and you want a really good solid note that will have multiple exit strategies, but will also be very attractive to owner finance buyers.
Well, then you want to make sure that you're going to scout it out the same way you would as far as a flip or a rental goes. You're going to go to mostly family occupied neighborhoods. You want, whatever the average is for that neighborhood. You want it to be in a median price range. Make sure it's affordable, because that people who are getting owner financing are also needing affordable housing. So all of those things.
Although
There is a
I've owner finance mansions
yeah, there is a huge market for larger homes.
and luxury properties, because those also, and you need to you'll see it more as if lending tightens up, especially on jumbo mortgages,
Mhm.
because then it gets really hard for those individuals to get jumbo mortgages and to put 20% down
Yes.
for something like that, so that if they could owner finance a jumbo mortgage with 10% down, they're all over it.
But those are more niche markets. I mean, that's really not for
Right.
You don't,
We're
want to
talking-
expose yourself like that and dive headfirst into a large mansion property.
No.
You'll work your way up to that one.
So the average owner finance buyer, you're looking for the 322.
Mm-hmm.
They love yards. The larger of a yard, the better, even if it's on a corner.
Yep.
And sometimes people don't like those corner lots.
Mm-hmm.
Owner finance buyers typically like them. And specifically what you said, no war zones.
Yeah. I mean, like you said, you can own or finance anything, but if you, as far as the exit strategies and your yields and everything else, you really want to stick to some the safe ground. We're talking if you're inexperienced and you're about to pivot because now the times are telling you, look, we've got to diversify. I don't want to just do flips. I don't want to do just rentals, or I want to take myself out of that equation a little bit more and own or finance. Just play it safe and stay in nicer, median income family neighborhoods, that sort of thing.
But again, too, you can own or finance things that need repairs.
Mm-hmm.
So if you come across, say, a listing, a property, and nobody's buying it because it needs so much work, you can buy that and own or finance it.
Easy breezy. Because a lot of times, like you mentioned earlier, yeah, we're talking about contractors that, maybe don't have the tax documents to qualify for a regular loan. They get paid in cash or whatever, and they're sucking that away. They don't want to pay rent anymore. Well, these contractors know how to fix those things. They know how to, put in new cabinets. Okay, I'll do that and I'll buy it at this price and I'll do that.
Well, and there's going to be a lot of rental landlords out there,
Mm-hmm.
right, who are going to get a property back and they're going to be like, oh my gosh, look at what this tenant did.
Mm-hmm.
And no matter how much you have as deposit on that property, even if you keep the whole thing, you may not have the money to really properly fix that thing up. Owner financing is an answer to this.
Absolutely.
So if you already have that property and you're like, God, I need to rehab this thing, but I can't, don't sell it at
a discount.
Well, sell it at a discount. We'll take off,
Yeah.
Something reasonable. Does it have to be the whole thing?
Well, I meant don't sell it to a wholesaler. Don't sell it at a
Right.
discount that way. But as a seller financer, then yeah, you can sell it at a discount and you're still making probably more money than you were as a rental. So it's an option.
And price point, typically we are dealing with lower
Lower to medium. Yeah.
lower to medium income range. So just kind of think $200,000 or less. ARV.
In our market. Now,
in our
granted,
market,
we're in Texas, Dallas-Fort Worth area, so we're thinking somewhere, not really exceeding the 300 mark, although I ended up doing an owner finance for 360. So, like I said, it takes all kinds and you just never know.
Right. There's no hard fast rules about what the desired property looks like.
But if you want to play it safe, then try to stay in that little medium.
It might also
zone.
be like a rental
Mm-hmm.
market. And then, as far as when you're looking to remodel, if you are going to do rehab on it, don't over rehab.
Do a rental rehab.
Yeah, just plain.
Yeah.
Because it's just not necessary. And remember, a lot of people buying this house, they're gonna change everything anyways.
Yeah, exactly. Because you're selling it to it. You are not renting it to them.
So let's talk about the borrower.
Okay.
Number one thing.
A lot of the borrowers don't that like to do seller financing. Maybe they're an I-10 borrower, and for those of you who don't know what an I-10 borrower is, that is an international borrower. That means they came here. They don't have a social security number, but they are legally here. Working in the United States, and they're allowed to buy property in the United States. There are certain loans out there available to them. Those loans are really expensive. So sometimes it's more appealing to just do the owner financing because they don't have to jump through all the hoops of doing an I-10 loan. But those loans are available to them. I-10 borrowers are very high on the list of seller financing buyers.
Right. And for everybody out there, your borrower needs to have one of these. They have to have an I-10 or social security number. If they do not, don't put them on the loan.
Yeah.
If their spouse has one, cool, great. Only put the spouse on the loan.
And that's really important for any exit strategy that you have. You're not just selling to anybody that walks through that. We're not trying to encourage anybody to sell to illegals or anything like that. This is why it's legal.
It's not so much, and it's not so much that one. I'm not going to buy it.
Yeah. As a note servicer.
As a note, right. And note servicer, if they're given a fake Social Security number or fake I-10, the note servicer is fined by the IRS for that. Does owner finance sometimes happen when a borrower doesn't have one of these? Absolutely, it does. But for tax purposes and all of that, it makes things very difficult. So make sure that whoever you put on, at least on the note and deed of trust, or on the mortgage, that they either have an I-10 or a Social Security number. You could put both husband and wife on the warranty deed as the owners of the property.
Yep.
But as long as, whoever is borrowing the money, they have to have an I-10 or a Social Security number.
Exactly.
So make sure that bad credit is okay. And I always say that I don't care if Sears, MasterCard, Rent-A-Center hates them, as long as their landlord loves them.
So bad credit, okay. You don't want a lot of evictions, because your whole purpose of doing this is you're seller financing. You're getting that money. You're trying to sell the property. You really don't want the property back. Now, granted, if you get the property back, is that okay? That's okay. You'll turn around and you'll sell it to somebody else. But
it's not okay. I'm very upset if I have a loan that doesn't perform, because that's more work for me.
Yeah.
Instead of me just going forward and building my business and getting more of them, now I've got to go focus on this. That's taking away from me just expanding my business.
I get that, but at the same time,
I know.
you still have the property, and that's the other beauty of this. I've got a friend of mine that lives in Spain, and all of her bills are paid off of one owner finance that she's resold 5 times.
And I get that.
So
I do, but be the bank, and the bank is not in the business of owning
property
or foreclosing on people.
Yeah,
they don't want to do it. They just want you to make your payments every month.
Exactly.
So
you're vetting them the same way you would vet somebody to rent that property. Although now you're saying, hey, bad credit's okay.
Right.
As long as you can do the down payment and afford this price point.
So and a lot of people just stop at the down payment. They're like, okay, this guy's got $20,000. I'm going to take this guy regardless. And I get that.
Yep.
I do. If somebody's got $20,000, they've probably been saving it up for a long time, and I'm probably going to say that they're a good bet.
Yeah.
But you do want to make sure that they're paying their rent on time, that their new mortgage with you is not going to be astronomically different, right? If you're about ready to double what they've been paying rent, you might be a little concerned, and you really should look, at other things as well, just to make sure that they can afford their new mortgage payment if they're about ready to double, because it's not just that. Chances are that their house is going to be bigger than that apartment, so they're also going to be doubling utilities.
Yep.
And there's a lot that goes into that, but also work history.
That's important.
If you see somebody that changes jobs every 6 months or every year, they might not be a very good
candidate. Yeah. But this goes back to, you vet your rental, just the same way. The only thing you're adding into this is bad credit, okay. And we'll do I-10, you're just adding a couple of things in, but you're still vetting that client, that buyer, because you want to sell that property. You want them to be good tenants. You want them, I say tenants, good buyers.
Good buyers.
You want them to stay. You want them to pay it off. And you don't want it to be a hassle. You want it to be drop it in your bank account and you're done.
Right. And there's, when you're looking at how much money they are bringing in, there's a couple ways to look at that. Some people look at their DTI or debt to income. Banks are all over the place on what they'll accept. Lenders, private lenders are all over the place on what they'll accept. Mm-hmm. I like to do the 3-to-1 rule for if their mortgage, principal, interest, taxes, and insurance, PITI, is going to be $1,000 a month. Mm-hmm. I want to see that they are bringing home
3 times.
Yep, 3,000. That's bringing home $3,000 a month. So
Yep.
obviously, if you've got a W-2 and you're looking at it, it's not $3,000 gross and then all of their
these deductions. Yeah.
Social Security and everything is taken out of it. I want to see that they're bringing home $3,000 a month, and then they can afford that.
Exactly. So just a couple of tips on vetting those buyers coming in, and stick by them. Because
Right.
once you start to vary, just like in rentals, once you vary from that, usually it kicks you in the butt.
Yeah, and for me, I talked to the landlord,
Mhm.
and I make sure they had the income to qualify, and that they've been working at their job for a while.
Yeah.
Your job is your credit.
Exactly. And so as far as professionals that are needed for this sort of thing,
Contractor, maybe.
depending on the property, just like anything else, when you pick up the property, I mean, if it's not, toilets aren't flushing, you probably want flushing toilets to sell it.
I always say give your owner finance buyer at least good, expensive structures, right? Make sure the foundation, the roof,
All the big tickets.
HVAC, make sure all of that is in good working condition. Everybody can go and paint.
Yep.
They can go put in, refinish their cabinets or put in new countertops or something like that. But not, when you start getting those expensive things, much, much better if those are at least functioning well.
Agreed. And then your realtor.
Which is also maybe, you could be putting out illegal bandit signs on your own. But
And maybe already have those. But if you decide, okay, I'm not getting enough bites off of social media,
or maybe you're too busy.
Yeah, or that, then you can put it with a realtor. There are realtors out there too, like myself, that are investor friendly and will list it at a discount because they know that you are going to be doing the due diligence. Unless they're vetting, then they might charge a little bit more. But I mean,
And I have
Get the
two
realtor.
and I have two realtors that only work with owner finance buyers.
oh really?
Yeah. Yeah. So again, those people are out there, network, find them.
Yeah,
And,
already have a list put together.
Right. So the next professionals that you really do need, and don't skip these steps. Never skip these. One is an RMLO.
Like we mentioned earlier, this one you don't skip. Don't leave yourself wide open. There's no reason to.
And so an RMLO is a residential mortgage loan originator, and these individuals are the ones that are going to be collecting the documents from your buyer. Ever since January 1st of 2014, you need to do this. I know your buddy said, if you only do 5 transactions or less a year, you don't need to do this. Baloney. You need to have information on your borrower. Let the RMLO handle it.
It's not worth it
No.
to try to
No.
skimp that one. I mean, that one can bite you big.
And right. And I mean, if you go in and you give somebody a house just because, they had $20,000 down, and lo and behold, they couldn't actually make those payments. When they go in front of a judge, the judge is going to ask to see that RMLO packet, that underwriting on that borrower. And if you don't have it, he could easily fine for the
Yeah.
borrower on that. And you risk losing every penny that they paid in down payment and interest.
That by this time it's probably spent, if you've already put it on another property. So you're putting other things at risk.
Right.
So,
Right.
and what would you say, as just so that they know, RMLO, what do they charge, what the rates are?
$1,200, $1,500.
Yeah.
Sometimes less, depending on all that they provide. A lot of RMLOs out there do, they're doing all of the disclosures, they're collecting all of those documents. But guess what? Your borrower pays for it. So even if you are rolling that cost in because, we could only go, they only had $10,000 down and they had to pay $1,500 for the RMLO, and they had to get a whole year of prepaid insurance. And
Yeah.
then we also had title policy, and we also had title fees. I get it. Those are some costs. And you're not going to walk with that full $10,000, but it's going to be rolled into the cost of your loan.
You're going to get it eventually.
You will.
Yeah.
Absolutely.
So it's worth it to cover. If somebody else is paying for it, it's worth it.
Right.
I mean, it's worth it even if you had to pay for it, but anyway.
Yeah, you need it.
Yeah.
You need it anyways. Don't skip it. So many people still skip this step, and it's just not worth it if things go bad.
Yep. And so an attorney.
and title company.
Yep.
So, and usually that's, the attorney is always
With a title company.
with a title
yeah.
company.
So they're going to do, they're going to do all the paperwork. You're gonna, like you said earlier, we're going to close at a title company, make it completely official, make sure that they're doing that title search, that everything, your title package, your title insurance, everything.
Right.
Yeah.
And
Just like a regular
and that
closing.
attorney is preparing the docs. And so people are always like, well, how do I do loan documents? Newsflash, you don't.
Yeah.
The attorney does them. And how do they do that? From your contract and your seller financing addendum. Yeah, you send that over to the attorney, and then they create your loan documents.
And then that way, once you have all of these things in line and in place and they've been paid for by your buyer, you have that so that later on you can, if you need out of it, all of a sudden, something happened. I lost my job and, the divorce, whatever happens, everything goes to hell and you're like, I need out of this property. You can sell that note to Kristen, or anybody that wants it. You don't have to put it up for sale. You don't have to, there are other options because you've done everything.
Or maybe there's
correctly.
something you want to invest in down the road.
Or that. And
And
you
you've
want
got-
to take that money out.
And you've got all this equity. You're like, oh, I've got these notes full of this equity. I could sell these notes and
Buy this apartment complex.
exactly.
Yeah.
And I work with a lot of investors who decide to do something like that. How do they come up with this cash? Selling a note. But if you don't make that best note possible,
It's harder to sell.
it's harder to sell. And so
or you're going to sell it at a discount.
right, you'll take a heavier discount on it. And really, it's not that I'm just going, hey, you need to sell every note you create. I'm not saying that. But you never know what exit strategy you're going to need down the road. And if it comes up that you do want or need to sell it, you want to make sure and have the best price.
Yep.
So don't be lazy at the beginning.
Yeah, don't skimp.
And then our final one is note servicer, which we've already talked about.
Mhm.
They collect all the payments. They send out monthly mortgage statements. They do IRS reporting. They make sure that insurance is on the property. So they collect insurance for property taxes.
So, they're
the-
taking care of that note for you.
They-
So that, again, it's less work for you.
It's-
Not only are you not taking care of the property, they're servicing that note so that you get your money and that's all you need to be bothered with.
And if you set it up at closing, your borrower's going to pay the $150 setup fee. And then they will also be paying that $35 a month
for that note servicer.
for that note servicer. And it's all rolled into their payment from the beginning. No questions about it. But again, you have to do it. And really having that third-party note servicer, it makes owning owner finance notes like this no work. Whereas I don't do anything with those. I just kind of park them in my portfolio, and then I get this little, report once a month, and I just send that to my accountant. I don't actually do anything. Sometimes I look at it.
Yeah.
Sometimes you get in there and you're like, okay, is everybody paid? But, that's about it.
So pretty passive.
Yeah,
So
it's
it
about as passive as you can get. It's about as passive as you can get.
You've got that, or you've got your Airbnb or rental
Airbnb is a
property.
hell of a lot of work. I'm doing those too.
I know.
If you don't want to do work, don't get an Airbnb.
Yeah.
No, don't do
Yeah.
that. No, yeah, this is a ton of work. But notes? Oh, I love my notes.
Yeah.
I don't have to do anything with those. So, that was my phone. Never mind. We're all good.
So, like we talked about and have been talking about, the multiple exit strategies with something like this. There are several exit strategies, and there's always different reasons, whether you're trying to grow your business or you're
Right.
trying to, liquidate or, something's come up. But you want to do all the things we just mentioned so that you do have the options for all these exit
and,
strategies.
And there are exit strategies for notes, as in the borrower could refinance.
Mm-hmm.
Doesn't really happen very much. Anybody who tells you is selling you something. I've had very few refinance over the years. So don't use that as a business model.
Yeah.
But it could happen. You could sell the note if you needed to. You could hold it for long term. You could sell even part of the note if you don't even have to sell the whole thing. So there's a lot of different ways going forward that you can, but you have to create the best note possible, which means a good down payment, minimum 10%. If you're not getting 10%, walk away, go get another buyer, and there's a ton of them out there who have it.
I remember the first time I ever heard like this whole strategy and everything. I mean, I'd heard seller financing since I got into real estate, but whenever I heard that people were just showing up with $20,000 and it's
They're
a
like, how the hell is this possible?
$120,000 house, I mean, I was confused. Like, how does this even happen? But
Where are these people coming up with,
from? Yeah,
where
yeah.
where are they coming up with $20,000?
Yeah.
It is. It's insane.
But it happens. It happens, and it happens every day.
So yeah, this is the next thing, loan to value, which confuses a lot of people.
Mm-hmm.
Loan to value is loan, right? What is that loan amount compared to the value of the property?
Yep.
So loan to value. Make sure that that doesn't exceed 80%. Which right now people are like, but if I only got 10% down and I can only go to a max loan to value of 80%, that kind of gets into the old 80-10-10, where you're creating an 80% first, a 10% second, and you've got your 10% down payment, and that all equals the 100% down.
Yeah.
So, and you could also do 75, 15, 10, or you can
split it up as much or as little as you want. I mean, you can get creative. This is already a creative process.
And you can also get 20% down on a lot of these.
Yeah.
And there are actually a lot of buyers who do have the 20% down. And in that case, you just do an 80-20 and that's fine.
Yeah. Well, and then the interest rates, like we were talking earlier, whenever you're dealing with interest rates, people don't just pull these interest rates out of thin air.
No, they don't.
Because once you start doing that, then you can get in trouble pretty quick, especially if we're talking about there's an underlying note. There are restrictions and guidelines there.
Your RMLO will tell you what the highest interest rate you can possibly charge is. Go listen to your RMLO. And
which is why you have one.
Which is why you're using one.
Yeah.
And your borrower is paying for it. Currently, right now, it's like 9.4, 9.5, somewhere around there.
Yep.
This number changes every day, so it's not like I'm sitting here quoting you mortgage rates.
Well, also, it changes every day because mortgage rates change every day.
Right.
It's based on what the mortgage rate, the going APR is out there, right?
Yeah.
So it's based on that, and then they come up with what mortgage rate is completely legal and viable with seller financing. Right. You're allowed to charge more because you're taking a larger risk, but you can't go out there and charge 19%.
No, in fact, depending on the state you're in, which in the state we're currently in, usury is 18%. Anything above 18% is against the law.
Yep.
Like really against the law. So definitely don't put 19% on your mortgage that you create because you were dumb enough not to go use an RMLO.
Yeah. So those restrictions are there. Those guidelines are there. You need to know those. And if you don't know those, obviously the RMLO.
Right. And so the last thing that is a really good baseline, figure out what you can rent that house for in the neighborhood. That is going to be, you're going to try to get close to that total payment for principal, interest, taxes, and insurance. And so if you can be, realistically around there.
I usually, whenever I'm dealing with owner financing or clients who are doing owner financing, we go ahead, we pull the comps for the rental properties. We see what the averages are, look at our property, compare, same as you would if you're renting the property or you're selling the property. But then because it's owner financing, it is typically slightly more than what rental is. We're not talking $500 more. We're talking like maybe $100, $200 more than what rents are. But
and again,
it depends.
It depends.
It depends.
And for me, I always kept it
a little bit lower.
I always kept it lower,
yeah.
And $50 to $100 lower, and because I don't ever want these back. That is my business model, and it has served me extremely well over the last decade.
Yep.
But I don't want them back. That means that the way I've set it up, if something happens to that family, let's say somebody gets sick and they have to move in with a relative, or let's say they get transferred out of state for a job, or they just can't work anymore and they've got to go live in a tent somewhere, they can rent that property out and not lose
Exactly.
their mortgage. They don't have to supplement that rental payment to make that mortgage payment.
Yep.
And in fact, they'll make $50 to $100, which might be, advantageous to them. At least it keeps them from putting the, keys in the mailbox and disappearing.
So, I mean, there's a couple of different strategies. It
For
depends
that.
on, it depends on how you work your properties. It depends on how you vet that buyer who's getting into that property. It all depends. Well, like that, it tends to be the going answer no matter
Again,
what.
it depends on what your own personal goals and strategies are.
Exactly.
And I'm not saying that, I know tons of investors who do. They put the total mortgage payment amount, PITI, to a little bit above where they could rent it. Totally get it. I don't do that, but it doesn't make me any more right or wrong than anybody else.
And it's all subject to what it is that you think is right for that property and your buyer and for you. You know, whatever your business plan is, as long as you stay within those legal guidelines.
Yeah.
Yeah.
All right, so now we're going to get into like the fund financing part and the thing called the wraparound mortgage. And people are shocked that this actually exists and why we use wraparound mortgage because technically a wraparound mortgage is a second lien. You've got your original debt, and we'll go in different ways to buy that, but you've got your debt that you've bought that house with. Call it a conventional loan. I just went to Bank of America, got a home loan on this house, and now I want to wrap it. And instead of using just a second lien, we use the wraparound mortgage because we want to capture that interest.
Exactly. And so you end up, I forget where I was going with this. You pointed at me and I'm like, huh? I'm like the kid that got called on and
called on and she's like,
I was staring.
Sorry, I lost my place.
So an example of that is a house, with a loan of $50,000. It's got a 5%.
That the investor owes.
Yeah. Yeah. And that's the house. That's what the original loan is. And then the investor sells that house, creates another loan, sells it to an owner finance, creates another loan, but they just sold it to that owner finance for $90,000.
Right. Well, create a $90,000 loan,
which is a wrap around that $50,000 loan.
Right.
So, and then you're charging your 9% interest because you're allowed to do that. You're allowed to do a higher interest rate than what's already on the property.
And this first, 5% loan is referenced on the wraparound loan. So you'll see it there. And that's how that's how your loan servicer will know, okay, well, I'm going to collect on this $90,000 loan, but then I'm going to subtract out
that $50,000.
Right, that principal and interest for that $50,000, and I'm going to first send that amount to that underlying loan holder, and then I'm going to send the profit to this investor, the owner finance investor.
Exactly. And so what kind of seller would possibly do that? Why would somebody sell their house for $50,000 when you could find a buyer for $90,000?
Well, how long have you owned that house? Or what kind of work did that house need? Or, we know that you can pick up property for very cheap. And remember, just because it says, $50,000 doesn't mean you bought it at $50,000. You might have actually bought it $70,000, $60,000, $70,000. But, you owe $50,000 on that house. And so you can wrap around it. The important part is, why do we do that? Because in the example that Jay Lee gave, you've got the investor will make 4% interest on that bottom $50,000 and 9% interest on that top $40,000. And all of that is done
with very little skin in the game for the investor.
Correct.
Who buys that wrap or who buys that original note and then wraps it.
Correct.
And that is the real attractive part of that whole wrap scenario, is getting into a property because somebody needs and is desperate to get out from underneath that property. Maybe they're out of time. Maybe it needs too much work. They They can't stick around. Maybe they've waited to the last possible minute to make any decisions, which happens a lot because people tend to stick their head in the sand. And this is their out. This is all that they can think of, to be out and wash their hands of it and be out from underneath it.
Correct. So that's why we do a wraparound mortgage.
It's profitable and very little money out of pocket.
Right. So how can you go and get started right now buying a house and financing it to do a wraparound mortgage and to create your own no work mortgage notes, completely passive income doing this?
Well, I mean, first thing, kind of like with anything that you do, any sales position that you've ever been in, if you haven't been in sales, the first thing you do, tell your friends and family. Social media. I don't know how many times we say that, like almost every show, we're like, social media.
Social media.
I mean, because now it's a little easier. You're not doing email blasts.
Right.
You're not, although you can, but it's not as hard to get in front of somebody and let them know, hey, I'm willing to do this. This is what I'm doing now.
Exactly. Yes. So I love that. Conventional loans, and let's preface this. Back in 2005 to 08, I had a lot of these, like a lot on my credit. And then they tightened them up and went to like, I think you can have like a max of 4. So I was completely toxic to lend money to. Be very careful with the amount of conventional loans that you get on your credit. Once you have 2 or 3, make sure and convert them over to a warehouse line, something commercial at a smaller bank. People are always concerned with conventional loans because they think that it's something called the due on sale clause, and that the bank is going to foreclose on them if they sell the house to somebody else, and they are not.
Yeah.
Most likely.
There is like a 0.001 chance, I mean, that clause is in there. It most definitely is, but it just doesn't happen very often.
No, and I have wrapped lots of conventional loans with Chase, B of A, Wells Fargo, and I've still never had one called. I actually had Bank of America call me on one of them and say, we noticed that you sold this property. And I went into this whole long spiel, and then they said, are you still going to make your mortgage payment? And I was like, well, yeah, of course. And they're like, okay, thank you. That's all we wanted to know. Hung up, never heard from them again. And so I can tell you right now, that is the due on sale clause is the option
that they have to go ahead and say, we want all that money.
If they
we
want it
paid in full right this second.
It is the option, but not the obligation.
Exactly. And, frankly, like we said before, banks really are not in the business of wanting that property back. They want those payments made.
Right. Right. So the next thing that you can look at is either IRA investors, private lenders. Those would be private individuals. Where do you find them? Social media.
Yep.
Facebook, going to any
a lot
type
of the
IRA.
a lot of the RIA groups, that sort of thing.
Yeah. And Subject 2 that we talked about a couple of weeks ago.
Yeah.
How to do that. And, one of them that I love that people don't realize is out there, if you find something that's an expired listing or a very stale listing, there's a reason why it's not selling. Go and talk to that seller about owner financing that property to you.
Because if they owner finance it and you can wrap it, I mean, it could end up being a win-win.
Right. And just remember, that guy is probably not watching this show right now. So you can negotiate like 3 or 4% because he doesn't know any better. And he's not going to go use an RMLO because he doesn't know any better.
Yeah.
And you're going to go do it at, 9.5%, 10%.
Which, I mean.
And I have heard of people getting 2 or 3%.
Yeah.
When they go to sellers to owner finance, which is less money than you spend at a bank.
Exactly. That's exactly what I was going to say. I'm like, sometimes you stumble across these and you're like, you got that for what? How did they, well, I put down 10,000. I'm like, that's not even 10%. Like, I don't even understand. But anyway, it happens. It happens all the time.
So the last one that you kind of need to be careful with are hard money lenders. A lot of hard money lenders cannot legally lend to a house that's occupied by an owner occupant. So be careful with hard money lenders. Some of them will allow you to wrap their hard money loan, but you've got a lot of disclosures there. You also have to have a very fast exit strategy for how you're getting out of that hard money loan.
Exactly, because I mean, hard money. There's a time and place for all of it, but you're paying premium for that.
You are. Not that the numbers, obviously if it's 50,000, you're wrapping it with 90,000.
Yeah,
You can still afford to pay 12 and charge 9.
yeah.
But it's, again, yes, be very, very careful with hard money lenders because they won't be happy about it.
Yeah. So, I mean, those right there are perfect examples. I mean, I know we were trying to break it down of like A to Z. What do you do? What are you looking for? What kind of buyer is out there? And then all systematically, how do you put this whole package together? The professionals that we need, and then how to find that money to go get that property.
Absolutely.
So, if y'all like our notes, which I say our, but they were prepared by the lovely and beautiful Kristen Gerst. And so just drop your name or something like that, drop your questions, and she can send that to you.
Yeah, I'll send out my notes on all of us. So, and any other questions you have, make sure and go to Real Estate Divas. We are really trying to build our YouTube channel right now. Like, share, subscribe, bribe your friends to also subscribe on YouTube to check us out.
Yeah. That would be nice. Yeah. Buy you a beer, that kind of thing.
Yeah. One beer with every subscription.
We'll throw a party or something. Yeah. Well, thanks for joining us today. Again, if y'all have any questions whatsoever, just drop them in the comments and we'll try to get back to you as soon as possible. We typically just kind of shoot the shit with everybody on the comments anyway. So thanks for watching today. I am Jaylee Thompson with Texel Real Estate.
And I am Kristen Gerst with Capricorn Mortgage. Send me your owner finance notes, please. I'm desperate for paper right now.
And if you're a realtor out there looking for a new home with an investor-friendly broker, give me a shout. Thanks so much, you guys.